and welcome everyone to introducing the COVID-19 Accelerating ESG Investment for a Resilient and Sustainable Future, sponsored by Apex Group. I'm so excited to have two excellent speakers with us today that are going to be talking about how COVID-19 has been accelerating a lot of the ESG, environmental, social, and governance impact investments and driving us more towards sustainability. It's all been on the front of our minds. We've been seeing the consequences if we don't think ahead, if we don't invest appropriately, and we've had a reality we've been warned about that has very much had an impact on us. So now that this is at the top of people's minds, we are excited to have this as our next part of our webinar series. With us today, we have participants from over 30 different countries around the world, family offices, institutional investors, high net worth individuals who are interested in learning about this topic, and we're so excited to engage with you. There is a Q&A that will be happening at the end of the session after two brief keynotes. Please send your questions in as they come. Feel free to ask them at any time. We'll be addressing as many questions as we can at the end of the session. So please look forward to addressing as many questions as possible from the Q&A session. Starting the conversation today will be Andrew Pitts-Tucker from Apex Group, who's going to be talking about the primary drivers for ESG engagement, some of the challenges and solutions for ESG investing, and how COVID has accelerated a positive change for this strategy. After a brief keynote from Andrew, I'll also be introducing Bert van der Vaart, from SEAF, who will also be discussing the consequences for COVID-19 and how they are going to accelerate a number of key trends, including digitization of services and an emphasis on resilient supply chains. He's also going to be talking about the negative consequences for commercial real estate, conventional banks, mass entertainment, and tourism, as well as how that affects impact sectors and how they generally benefit, focusing on the have to have and the not nice to have. There's also going to be a discussion on the communication through the SDG, or the Sustainable Development Goal indicators, as a safe harbor for investment post-COVID. Again, starting off today will be Andrew Pitts-Tucker, who has over 24 years of experience in the financial markets sector. He's most recently been running global distribution in the Sustainable Investments Division of Deutsche Asset Management. He recently joined Apex in September 2019 and has been specifically responsible for driving the group's ESG development through its subsidiary Apex ESG Ratings, and has led the build out of a unique end-to-end rating, reporting, and advisory service specific to the private markets, which has recently went live, but has been phenomenally strong, driving both from Apex's reputation and a good reception from the clients that are in significant need of such a service. Prior to becoming managing director of Apex ESG Ratings, he spent 3 years developing sustainable business models for protected areas and conservation initiatives in sub-Saharan Africa. I can also say, as Down the Capital, we're big clients of Apex, great organization. We have several funds under their administration. So we were extremely excited to see them have Andrew joining their team and rolling out this highly needed ESG infrastructure. Without further ado, Andrew, really looking forward to discussing this with you and to hearing your keynote. I have a lot of questions already for you, but if I could hand over to you.
Brilliant, thanks. Zach, really appreciate that introduction. I don't need to say too much more about myself. I don't want to bore you with my past. ESG is all about the now, it's all about the future. And first of all, thank you so much for inviting me and giving me the opportunity to share my thoughts, which are both personal and they are also representing Apex. I'm very lucky to work for Apex. It's an amazing organization. As Zach mentioned, it's the fourth largest financial services provider in the world. It's got over 3,000 employees. It's in 40 offices. It's got 6,500 clients. But what really excited me about joining Apex was that it's incredibly serious about affecting meaningful change. And that starts at the top. Peter Hughes, who's the CEO and founder, he's incredibly passionate about doing good for people and planet. He's very focused on the environment. He's very focused on social matters. And in fact, we met through wildlife conservation in Africa. Prior to doing this, as Zach mentioned, I spent 4 years working in the conservation sector in sub-Saharan Africa, working on wildlife projects and protected area landscapes, helping them define more sustainable business models. So, I got his passion. Apex is incredibly keen about supporting clients. It's a key aspect and real focus for Apex. And increasingly, they've been asking about ESG. How can they collect data? What data do they need to collect? Does it need to be independently sourced? How do we score and rate data? You will get it. There's a huge amount of questions around ESG. And we weren't in a position to answer them. And having 6,500 clients, as you can imagine, we need to listen to what they're asking us and we need to change accordingly. So a year ago, Peter asked me to join. We were sitting under a tree down in sub-Saharan Africa and he says, look, I've got this idea. Do you want to come and do it? So I said, yes, straight away. This is a great opportunity to push ESG far and wide and to do our part. But look, before we started out building our product, we went out to the market and we listened to what they had to say. We went out to as many stakeholders as we could and we listened to their thoughts, their concerns. We wanted to hear what everybody was saying about ESG. And so my next 5 or 10 minutes is going to be really a summary of what they thought. And it was only after we had listened and we'd heard what the main drivers were, what the main problems and blockages were, did we really build our product. And the market is telling us that what we've created is quite a unique offering. So it's a really exciting time. Great to be here. Now I'm going to move on to the world of ESG. So bear with me. I'm just going to share my screen. Okay. So to summarize, the discussion is going to be broken down into 2 parts, and really that's going to focus on drivers for engagement and barriers and problems that keep surfacing and keep being reasons why people aren't engaging in ESG. So let's look at the drivers first. If I break it down into 2 factors, and I call them the push and the pull factors. The pull factors are employee pressure, it's moral obligation. The push factors being from on high, it's investor pressure and it's regulation. So employee pressure, that is building significantly. From the inside out, employees want to make a change. They want to change their companies. People want to work for purpose-driven organizations. Stand out more than just making money. And I think what's really important here, this is key for the companies as well. This is about recruitment. If you show yourself to be an organization with purpose, you're going to recruit the right people. You're going to keep those people for a long time. You're going to keep them motivated, absolutely critical. And I think those metrics have been overlooked in recent years, and they're vital towards the success of a company. Moral obligation. This is all about the realization that the planet is in big trouble, not just environmentally, but socially as well. It's being felt at a very personal level. And it's more and more obvious that it's our duty and not just the next generation to leave the world in a better place than we found it. Prior to COVID-19, there was significant focus on climate change. News was awash with unfolding natural disasters, from devastating forest fires to destruction of the rainforest, plastic pollution, and so on. In my view, COVID has actually enhanced the E factor in ESG by highlighting the benefits of a relatively pollution-free planet, but also the importance of biodiversity in a situation where we have seen disease transferred from species to species, and it is as a direct result of us. But right now, during COVID, and as we crawl back to some sense of normality, the spotlight has really established itself on the S, on the social factor of ESG. And what do I mean by that? I'm talking about human capital management, and I'm talking about social justice. So COVID has really highlighted those 2 factors significantly since we have started to draw ourselves out of this crisis. Okay, 2 other facts I want to talk about. Regulation. National, supranational governments and unions, they're driving change, regulating across ESG. It's not something which is going away. Companies need to be careful. They need to be a step ahead. They need to show that they're market leaders and that their credentials are solid before they're forced to change en masse. Because at this point, when legislation kicks in, it's going to be hard to differentiate. And that's something you've got to be aware of. As of March 2021, the Sustainable Finance Disclosure Regulation imposes mandatory ESG disclosure obligations for asset managers, private banks, and other financial market participants. Now, significant action is going to be needed to comply with this. I'm not a legal expert, so I'm not going to advise on this call, but I really recommend you talk to your counsel for further guidance on this. And really the final point is it's investor pressure. Investors have translated the needs and requests of the end investor, which is us, you and I, as well as the necessary regulatory requirements, and applied this to their investment processes. This fiduciary requirement has been moving down the financial supply chain, and increasingly it's becoming a need to rather than a nice to do. But investors, they're also acting out of a sense of duty, and this is really important. In the last couple of days, BlackRock has commented that they're going to be putting significantly more emphasis, for example, on human capital management when assessing their investments. And this is as a direct result of how companies dealt with the pandemic. And this comes after their CEO, Larry Fink, in a letter to the CEOs of their investee companies earlier in the year, highlighted that sustainability and transparency were going to be key attributes for all their future investments. And that it was going to be their fiduciary duty to help clients navigate this transition to a more environmental and socially responsible investment methodology. So, having looked at the drivers, let's have a look at some of the barriers which came to surface while we were out there talking to our stakeholders. A number of major themes. This will be no surprise to you. Number one, does it suffocate returns? This has been an ongoing debate for a substantial amount of time. There is increasing evidence that shows it actually may enhance values and returns. Morningstar recently published a report showing that the majority of 750 European-based ESG funds outperformed the wider market over 1, 3, 5, and 10 years. Now, this counters claims that suggest ESG investments come with a return sacrifice. And I think what's really important, as more and more data comes out on this, and we're able to really generate better correlation outputs, I think we're only going to see this point strengthen, which is going to ultimately mean that ESG, it ain't going anywhere. It's here to stay, and it's no longer just nice to have. Interestingly, in another report that they published recently, they showed that very specifically during the COVID-19 pandemic, sustainable and ESG funds, they saw net inflows in Q1 of circa $45 billion versus the rest of the universe that saw outflows of circa $380 billion. So something positive is happening here. People are beginning to recognize the importance of applying ESG matrix. Other factors that surfaced as part of our questioning the stakeholders: clunky data collection. It's painful for companies. What data do they collect? How do they collect it? There was a distinct gap when it comes to collecting data on private markets, which is the area we chose to specialize in. But I think what's really important, all methodology needs to be cleanly wrapped in intuitive software. A lot of companies, during the conversations we had, were quite surprised to hear that they are already doing ESG, inverted commas. What do I mean by that? They already have governance models. They have social and environmental policies which they're implementing. But a lot of companies haven't really appreciated that this is what ESG is all about. And it's a relatively new term for them. So actually, what the missing piece is here, it's about collecting that data and putting it into a format that can be used intuitively and allowing the investor and the company to make really meaningful changes to satisfy stakeholders as well as part of the reporting process. Other factors which came up: regulation, of course, and reporting. How do we satisfy regulation whilst also reporting to our investors and also to associations? There's a lot of people that they're trying to keep happy. And in our view, it comes back to data. These different stakeholders, in our view, they're utilizing very, very similar standards that their disclosure demands. And so long as we understand what those standards are and we break it down into very specific KPI and data points, and so long as we have got that data, we can chop and shape that data as is needed, and we can apply it to the reporting needs of those various stakeholders. But specifically on regulation, I mentioned it just now up above. I mentioned March 2021. That is suddenly going to approach. the tailwind of regulation is gathering speed at a terrific pace, and it's our sense that the market just simply isn't ready for March 2021. Now, that's a fairly general comment, and I appreciate that many on this call are probably going to be very well positioned, but I can assure you a lot of the companies I've spoken to simply aren't. The concern is that we could see a sort of a GDPR-like scramble right at the end, and I really encourage you, as mentioned above, to take the necessary advice. Talk to your lawyers and talk to your financial services provider about what can be done to help. Two more thoughts coming from the stakeholders. Differing methodologies. Yes, I get it. It's unregulated. It's highly complicated. There are many standards out there. A lot of them looking to be the best in class, but in our view, they all potentially have a role. Businesses should be aligned with the best global standards in each area. This will ensure integrity, relevance, and longevity. It's absolutely vital. Most importantly, though, they all have, in our view, a common guiding principle. We've looked at a huge number of these, and that really is all about transparency, and that the very fact that a company being transparent will lead to an increase in trust. And within our methodology, within our product, we've chosen to align with a number of global standards, bringing them all together under one umbrella, which in our view not only define best in class now, but also best in class for the future. We're really looking to simplify and consolidate rather than add complication. And the last point of concern for a lot of people, and the last barrier, really was all about greenwashing and purpose washing. Are people becoming ever more cynical about companies posting ESG data? And there are ways around it. Maybe it's time to think, okay, I'm not going to mark my own book anymore. I'm not going to score my own exam sheet. Okay, independence has worked and has been a defining part of the financial reporting market for many years. Just maybe we're going to see the ESG world go exactly the same way. So really think about independence, and that's what we've sought to do, is to provide an independent methodology for collecting data and reporting. But look, that's really the major points that I wanted to make here, and I hope it gives you some thought for questions after Bert has finished. But having listened to the challenges and opportunities in the market, we've made a concerted effort to fill these gaps, and I think our product satisfies that. But my final comment, really, it's a call to arms, and this is something which I am incredibly passionate about. ESG is about doing the right thing. It's time to embrace ESG, both personally and at business level, for all the right reasons. It's here to stay, it's accelerating, and it's enormously powerful. The financial sector has a significant duty to play its part. And I know the very fact that you're on this call, you care about it. And my one ask is, we all take something away and make a difference when we get off this call. Look, thank you. That's enough from me. I'm going to hand it over to Bert now, and he's going to play his part. And then between us, we're going to try and answer some questions. So thank you very much for listening.
Thank you, Andrew. I'll be introducing Bert in just a second. Again, that was a great start, highlighting the importance of ESG and the importance that ESG needs to be more, and ESG and impact needs to be more than something that happens in the marketing department, right? It needs to be happening at the highest levels of corporate governance, and needs to become a core part of the company. And part of that is being driven by having the data and the reporting, the objectivity and the analysis to demonstrate whether those principles are actually being followed. And I think for on the one side, investors recognize the importance, but they have become jaded to after seeing ESG and CSR all kind of happening in the marketing department, but not being implemented at the highest levels. So that's where we're seeing a big change, and that's being driven by investors who demand more, who have been disappointed with promises that were not fulfilled. And I can certainly say that Bert has been a guiding light in the example of how to actually implement ESG and how this is more than just a marketing term, but a philosophy and central to a strategy, and a strategy that actually drives out performance. Bert co-founded the Small Enterprise Assistance Funds, or SEAF, in 1989. He led the growth of SEAF to more than $1.2 billion in total capital across 40 different investment funds. He's invested in more than 450 different companies in Central and Eastern Europe, Latin America, Asia, and Africa. SEAF is committed to achieving strong positive developmental impact with commercial returns through investing in entrepreneurs in underserved markets. Previously to SEAF, Mr. Van der Vaart was a partner at Gibson, Dunn & Crutcher, one of the world's most prestigious law firms, particularly in the private equity and investment space. Prior to that, he was a management consultant with Bain & Company in London and Munich. He served as a principal advisor for Discovery Global Citizens Fund, a Connecticut-based emerging markets hedge fund. Bert, it's such a pleasure to have you with us today. I'm so excited to discuss some of the topics that we've discussed before this call. Someone who's been living and breathing this and implementing this before it was a buzzword, before it was a marketing term, and that it's kind of central to your DNA. So really looking forward to your presentation and then opening up the Q&A at the end of the session.
Zach, thank you very much. That was a great introduction. I really enjoyed Andrew's very comprehensive discussion of why the trend towards ESG, why the trend towards impact makes sense these days. Certainly, I think we've heard that COVID is accelerating lots of trends. They're trending, doing business by Zoom. I mean, we see webinars. We've seen the possibility over the last 4 months of transacting our business without traveling. I thought that was never going to be possible. We've seen it on digitization. Obviously, a lot of financial transactions are now doing over the internet. Many people were a little bit afraid of that. Now they've been forced to it. It's all going. And it's on impact. And I think the impact side very much is driven by the factors that Andrew was talking about. I just want to give two sort of examples which might really bring that to life. One, we're seeing the effects of the younger generations of millennials who want to make sure that what their businesses are doing are making a positive difference. When we're looking at all this insecurity, when we're looking at all this poverty, when we're looking at all the climate issues around us, the inequality issues that have been sweeping, I think, a lot of our countries, they really want to say, if they're in a family office, if they're the next generation, they want to make sure that their capital is allocated to things that are making things better. On the government side, what we're seeing is many governments are running out of fiscal room. And that is, as Andrew was indicating, leading them towards moving towards regulation. So if you're in effect in a position of trust, governments, in fact, we've been advising a number of smaller governments who've been coming to us. They trust us because they've seen us making a difference, and we've always been looking at the impact on the community, the impact on the SDG criteria. And then they're saying, what do we do post-COVID? How are we doing it? Because we don't have money. There's too much debt out there. We really do need to bring capital to addressing the biggest issues. And I think that's really what the major message is I want to say. Just very briefly, SEAF is, since 1989, been investing around the world. You can see the flags of the countries in which we invest. And I think what we've seen in particular is there's great entrepreneurs everywhere, including in smaller countries. I think too often the emerging markets are looked at as just going to the very large countries. In fact, we're seeing great entrepreneurs everywhere, and the whole world is becoming, I think, smaller as a result of this. At the same time, and one of the factors, Zach, that you mentioned at the beginning, which I think is important, is that the issue of resilience is important. I think that it's impossible probably ever to fully replace China as a supply source, but many people, when COVID first hit, realized that they were too dependent on one, and particularly just-in-time global supply chains. And I think there's been a movement in the United States and Canada, certainly, to looking at places closer to home, Central America, for example. And in Europe, I think we're seeing a lot of demand, both in the Northern Africa and the Levant, in terms of replacing some of the supply chain that was exclusively for Asia. these are the numbers. We've also, I must say, very happily established a Center for Entrepreneurship and Executive Development, which has now more than 35,000 members in 14, 15 different countries. And that really gives us a unique understanding of what's going on at the ground in these countries. The expected changes to economies, as we've mentioned, I think foreign investment, particularly equity investment, is going to be critical. I think banks have been, in many cases, deferring deep payments, but those deferrals are actually accumulating. And so there's quite a large debt hill, if not mountain, building for a lot of the companies, particularly in those countries that have less institutional equity. And at the same time, we're seeing the banks having lent to commercial real estate. You mentioned that too, Zachary, where a lot of people are trying to move away from expensive buildings or reduce the amount of office space that they need. So there's going to be pressure on the banks. They're going to be dealing with their existing portfolio and their larger credits. And that means that there is a lot of a lack of institutional equity for the growth side. It also means that a number of sectors like fintech, I think, will develop, particularly if there are, going back to the major theme, benefits to the community, benefits to the economy, then they will be supported. And governments are going to be looking at any new disruptive technology in the light of, is this actually going to improve the lives of the community, or more people being thrown out of work? So I think we can see that. I think that regionally, we really do see opportunities where the robustness and the resilience will be improved. As I say, the global supply chains are going to at least be attenuated at some level, and I think that people want to play with people that they trust. That word trust, which Andrew uses, is central to everything. I think at the end of the day, trust needs to be there for governments, trust needs to be there for employees and for counterparties, and then ultimately trust needs to be there for investors as well. And I think what we're seeing with investors is they're looking at impact not only as in a world of declining returns. If you're going to get high single digits or mid double digits, you certainly want to get impact along with it, because frankly, it's a risk management issue. There's less risk if you take into account both the sectors that are have to have, and there's less risk from a regulatory point of view. So I think in those cases, this is a kind of a convergence of all these themes of people, valued employees, of governments who need to improve their economies in the wake of COVID, and of investors. So we are really excited. Obviously, there's been a lot of damage done by COVID, but in terms of rebuilding, we think that impact investment is a critical part. Among the themes, there's many people who look on a company by company basis, and I think Andrew's comments are perfect on that. I think a lot of investors are looking for some specific themes, whether they're going to be investing through a gender lens, the notion being that often cases the purchasing power of women and children have been underrepresented, or the diversity and the top management of women have been underrepresented. Forcibly displaced people, there's more than 75 million people around the world, and there's lots of vulnerabilities and needs to work with entrepreneurs that take care of those issues, because I don't think we can expect governments to do that. Tech deployment for impact, we've touched on some of that. That's particularly true if we're looking at health tech or agri-tech or edu-tech, and we're looking at education. So much is now going online. There's an enormous amount of interest from parents, both to keep their children safe, but also, frankly, to improve the quality of the education. And while that was beginning to happen, I think we're seeing an acceleration, certainly in Morocco and Vietnam. We've had some ed tech companies that are doing really well. The agri-tech chain, I think whether it's water and input management or reduced waste, there's enormous pressure on these value chains. Also, there's a need to move to robust and resilience. And then the general topic of quality jobs, where mission is so important, as well as treating people in an equal basis. I think reducing churn and improving maintenance and retention of employees. So I think those are some of the key themes. I'm sure there will be lots of questions as well. And I think at the end of the day, we do need, I think, all of us to be part of this converging coalition that factors in impact, that factors in ESG in the way that we do business going forward. Very happy to answer any questions and really appreciate this opportunity. Hats off to AIM for putting that together and to Dalma Capital. Thanks, Zachary.
Excellent, thank you, Bert. So we already have quite a few questions that have come in on the Q&A. I think I'll start actually with a question from Gary Vandervorst. Given that both of you have some experience investing in Africa, what is the meaning of impact investing in Africa? Have you invested in Africa before, during, after COVID-19? Has that changed your thesis on Africa at all from an impact perspective, from an ESG perspective? And how might investments in Africa, impact investments in Africa, differ from an impact investment in the Western or developed economies? Maybe Bert, if you could start
Sure.
off, and then I'll ask Andrew as well.
Great. Well, I mean, it's a great question. I think in terms of meaning of impact, from our perspective, we are very comfortable using the language of the SDGs. I think Andrew's methodology to demonstrate and to retain the impact in a particular business or over a fund, I think is, of course, relevant as well. It is important to define upfront what you believe impact is, and then obviously you can be held accountable to it. But the SDGs really do, I think, fit the bill in our view, because they really define those areas around the world where there is inequality and where there is a need to redress those inequalities. And so any investments that impact an SDG criteria, in our view, improves, makes better, and is unambiguously so. And I think that language has been, I think, a very important part of the entire move to impact. In terms of Africa post-COVID, we're preparing. We're in Tanzania and Kenya. We're also in Northern Africa. I think Northern Africa, we are really seeing great opportunities, frankly, with respect to e-commerce and content over lines, and certainly also in terms of providing services to Europe as well as to the Mediterranean more generally. Sub-Saharan Africa, we like the ag value chain. We think 60% of the world's arable land is in Africa. There needs to be attention placed in terms of using the technology that would deal with the climate change issues and the volatilities. But clearly, what we are seeing in Africa is a distressing drop in the per capita income. I think lockdowns in Africa are extremely damaging, and the governments don't have the fiscal means to really do as they do in many of the more wealthy countries, of being able to support their population while they're trying to flatten the curve. So we are sure that both ag tech and health tech are going to be a very important part of recovery in Africa, and we are in fact working together with a large NGO, Heifer, to look at a value chain, particularly in Ethiopia and Eastern Africa post-COVID. So that's a part of it. I know, Gary, you're involved in the mining industry, and there's enormous benefits, what you were talking there about both how you treat the communities, how you treat the employees. It's important. I think you're responding already to what investors are going to be looking at in terms of the risk factors and in terms of the future support that those companies will have from the governments, et cetera, by anticipating those needs. That's part of the answer. I don't know, Andrew, you probably will correct and expand. So.
No, not at all. I think you summed it up very nicely. I think the opportunity, the investment opportunity you talked about is absolutely right. The agricultural supply chain is still an area which has got massive potential upside. Green energy production as well, I think, is another area that over the course of the next 5 to 10 years is going to see huge expansion. But I think what I'd like to do is just draw your attention to my view on the difference between impact investing and sustainable investing. Impact investing is about generating positive returns which are non-financial. Sustainable investing, in my view, is about seeking investments that both have solid market normal financial returns, but also incorporate positive environmental, social, and governance upside as well. And so when we're talking about measuring and scoring the investments that you're making in Africa or any part of the world, there's two parts to it. There is what I would call the ESG matrix. ESG matrix, in our view, and the data set that we've sought to create, is agnostic to sector. It's agnostic to geography. And what we're talking about here is environmental, social, governance, data points and KPIs, which really are no more than good old-fashioned business practice. And that is what it is all about. But I don't want to, impact is vitally important. And where people are focusing on impact, there are going to be very specific KPIs to those specific industries. It could be a specific project. And it's vitally important that you map those out at day one, before day one of your investment. They should be mapped out at the pre-screening stage and then implemented as part of your 100-day plan, which is the start of your relationship with that investment that you're in. But that's all I wanted to add.
Yeah, and I think that actually when we're talking about Africa, this is one of the challenges, and we do need to differentiate when we're having a positive societal impact, and in cases where it can come into contravention with environmental impact. When we're investing not just in Africa, but any developing economy that hasn't had or is still in the process of the industrialization. Let's remember when Britain and the United States were in the industrial era, there were smokestacks and we were pumping things out in the environment, and that was creating jobs and that was creating wealth. These countries, a lot of countries haven't had the luxury of having that opportunity, are now facing the challenge that the rest of the world is saying, well, you can't pollute, but they need clean sources of energy. And a lot of these countries happen to be very mineral and natural resource rich. So this is one of the challenges that we've seen for a lot of great organizations, great companies, great initiatives in Africa seeking to raise capital, where a lot of allocators are saying, well, you're in mining, you're dirty, you're in, your sources of energy are not clean. We can't invest in that. And that overlook the positive impact that those are having on society. So I think that's a discussion and topic in and of itself. But just to come to another question by one of the anonymous attendees, for us, and what we see is at the end of the day, it all starts at the top. It all starts, Bert, down with Capital, Steve, Andrew, we're all somewhere in the value chain, but that all starts with allocators, with investors. Where are they deploying capital, right? Where do they want to, where do they want to be, where do they actually want to invest? And all we can do is try to do the best in our particular segment, specialty, to deliver for them. But how has the change in the allocator, institutional investor, family office investor appetite been driving the increased focus on ESG? How is that affecting portfolios of allocators like pension funds, like family offices? Bert, if you could maybe give us a quick view on that. And I'd also like to understand for them, how important is it that there's the real impact, or are they just looking for you to tick a box?
That's a great question. I think certainly large pension funds have been struggling. Obviously, TPG Rise has been able to successfully tap into them. They've been struggling to find private equity funds, at any rate, that are able to do big enough deals in impact, because a lot of this is a beginning, as a new kind of world. So I think what we've seen more generally is going into green bonds. Debt equity with interest rates low, at any rate, I think there is an acceptance from insurance companies and pension funds in Western Europe and in Canada, the United States, that this is a good place to start with impact. I think on the private equity side, it's much less, frankly. There's still, the DFIs play a big role. And the pension funds that are coming into our funds are kind of tippy-toeing, $15, $20 million pieces. They're not putting huge pieces in, because they want to see how this really works. I look at this almost as, it's partly because within the within the pension funds, there are people who, younger people who clearly want to drive impact and are willing to spend the additional time on this. But B, at the top end, for risk side issues as well as for public relations issues, I think there is support for impact on equity. Again, debt is much easier than I think private equity. I would say, interestingly, we're raising a lot of local money. And so large investors, large institutions in Algeria or in Colombia or in India, I think there is more of a willingness to invest in impact themes, in part because they believe their own countries need it, in part because they're anticipating regulators saying you shouldn't put all your money in KKR in the United States. You need to do things in your local countries as well. So a little bit of a mixed bag. On family offices, what I really see is the impact of the next generation. In fact, a number of asset managers, Swiss asset managers, who are certainly, I don't think, born and bred with impact as part of their DNA. What they have done analysis, I think McKinsey did a report, is that 80% of the wealth managers shift when there's a change in generation. The new generation wants to have their own advisor, so to speak, and impact is becoming a big part of that. So we're getting a lot of wealth management firms that have families, particularly families that are grouped geographically, and they say we want investments in Turkey, or we want investments in Central America, or whatever. And these families are dipping $5 million pieces, $10 million pieces, still carefully, but I think they all do realize that this is a theme that they don't want to be late to. If not exactly leader, once these funds are coming out, they want to join. And I think everybody is rooting for those reasons that Andrew put out as far as why impact is going. Everybody sees that, and I think they're dipping into it. So I think there's a shift over. Some families are 100% impact, and that means they're doing everything from green real estate to private equity, a mixture of developed and developing markets, etc. But I think that's still a relatively small proportion of the family offices. I think people are moving their assets over gradually and waiting to see performance.
Yeah.
Since we're actually already most of the way through the session, if we have so many Q&A, if you don't mind, Andrew, if I can move to the next topic, because it's specifically focused on actually one of your areas of expertise. With respect to regulation, members of the board of the US SEC, including the chairman, Jay Clayton, have been critical, commenting on ESG ratings and so-called experts not being material or meaningful to investors, with resources spent to produce such ratings being wasteful. How do you think what's your opinion on ESG reporting? What are the key things what are the key problems that need to be solved right now to make this reporting objective, efficient, meaningful for investors? Because people are really starting, from what we're seeing, people are really starting to get quite jaded about ESG ratings and a lot of these certifications.
Yeah, you're absolutely right. I totally agree. Everyone we speak to, there's almost a sigh when we talk about who are you looking to satisfy? What data are we looking to collect? And I think the very important thing, and I mentioned it earlier, it is about data. Data is absolutely everything. One of the criticisms that we find from a lot of our companies is that the previous methodologies that they have used to generate reports and so on and so forth, it's in Excel format, it's in Word documents, and they've got them on their Y drive scattered out throughout their computer. The problem with that is it may be very, very good information, but it's very hard to use it when it's so broken up and in many different storage places. And when you've got to report to stakeholders because your investor wants to know what you're up to, when you've got to report to an association that you signed up to, when you've got to satisfy regulation, which direction do you go in? And that is really, really hard. But I think bringing it back to the point that I mentioned earlier, if you look at the associations, if you look at regulation, the EU taxonomy, the sustainable disclosures, you look at what the UN are advising around climate change alignment, it all comes down to the data and the KPIs set by a number of standards. And we're talking the SASBs, we're talking the GRIs, we're talking TCFD. The data points are what you need to collect. Once you've collected that data, you can then chop and change that data, and you can satisfy the stakeholders with the relevant reports that they need. And that is, it's absolutely crucial that people get that very, very basic stage right. So it's, don't pick your one standard to align to. There's a lot of alignments there's a lot of standards out there which you need to align to satisfy ongoing regulation. Regulation is black and white. You're going to have to. You're going to have to bow down to regulation. So, if that's your starting point, use that as your starting point, and then build out your KPIs. Understand what data you need to collect. The likes of us, likes of your council, they're here to help. We'll work with you to achieve that. But the important thing then is getting the report done in a format that is right for the stakeholder as well. So it's all about collaboration. Talk to each other. If you can talk as an investor sitting in the middle, if you can talk to your underlying investee companies, and you can have your investor on the phone at the same time, and you can work together, work out what's right, it's going to be so much easier for everybody.
Yeah, absolutely. And this is one of the key issues. And something has happened during COVID that has actually really brought this issue to the forefront. I think now that people are taking a serious look and thinking about, okay, you know what, we were warned about this. Now we've been warned about climate change. We've been warned about, other social issues that are rising. And actually, while a lot of ESG impact investing, a lot of it has, people the first thing that comes to their mind is environmental. You mentioned that, Bert, one of the kind of ways that allocators are kind of deploying capital into this space is green bonds, and green bonds, are biased capital towards a certain segment of capital intensive, asset-backed, yield generating assets like, solar and renewables, but there is a lot more meaning to impact and investing than just environment. One of them being social. And in light of the fallout from COVID, the ongoing social tensions that are arising in the United States, in other economies around the world, and one of the kind of overhangs that I fear about all of this, money that's been pumped into the system is that widening of the gulf between the owners of capital and the people who generate income with their blood, sweat, and tears, the capital and labor. So how is that kind of dynamic driving the social aspect of impact investing? And what do you think that this is going to how is this going to change the landscape, in the post-COVID world, Bert?
Completely. It's a huge theme. I think it's really been brought out with George Floyd killing and the aftermath. What we see in the United States, and Agnes Dasovitz and I wrote an article in Fortune last week on this one, is that if you look at institutional private equity in the United States, 80% of venture capital goes to 3 states, and it goes to California, New York, and Boston. That means there's a huge part of the country that is not being touched by institutional risk capital. And that's where the inequalities come. So if you look at the election, the populism in a lot of states, a lot of countries, certainly also our country, it is in part because the economic opportunities seem to be so unequally distributed. And what's necessary, I think, on the impact side is by focusing on communities and on local value chains, for example, on the organic agricultural or sustainably harvested meat. There's a number of areas where people are basically preferring to eat local. What we're seeing in a sense is that there's local monies, insurance companies in Durham, North Carolina that want to invest closer to Durham, North Carolina. So there is in some sense a move away from global towards communities in order to address some of these perceived inequalities. I think as a theme, you get now to the metrics. I think one of the very important things on the metrics is to benchmark where you are, whether it's minority-led risk capital managers, whether it's diversity in the decision-making process, because most people will realize that people invest in in companies and in people that they are most comfortable with. So there's I think less than 1% of institutional capital in the United States is managed by minorities. So those, if you will, you start with those metrics, then there are opportunities for managers who are able to provide a product that addresses those perceived inequalities. I think that's going to be a huge theme in the United States, but our Dutch office is saying, gee, this is happening in the Netherlands as well, that we have communities that have come from different parts in the colonial history that are underrepresented in terms of risk capital, and that there are entrepreneurs who, as a result, or parts of the Netherlands, the West is certainly extremely, if it's a small country, but the West is certainly so much more invested in than the east of the country. So I think you're seeing people realizing, and maybe COVID, our self-isolation at some level has really brought those geographical boundaries a bit closer to us. But I think it's going to be an important theme, certainly for local institutional capital, to be a little bit more concerned about the impact in their local regions. Again, what we talked about, regulations, or we can anticipate local governments looking where the money is and trying to press them to put money in the right areas. And then there are certain other areas that have just been so underrepresented that they would be attractive to capital from the outside as well. Those are just some of the answers to this, but Zach, I think you're really talking about a very important theme for the next 10 years. I think that is going to have to be addressed.
Andrew, would you be able to add to this? It's such an important topic, or?
Yeah, it's a huge topic. The only other thing really I wanted to say was human capital management is going to be absolutely, for the next 5 to 10 years, it's going to be absolutely at the fore. And I think one of the things that COVID-19 has brought out is how companies treat their employees. There's been a huge range of stories in the UK, and that's undoubtedly going to apply to the rest of the world as well. You've had these glory stories of companies that have done so much to look after and safeguard their employees through the situation. You've had companies that have done completely the opposite, and literally they've just thrown the towel in and haven't been able to react. And I think investors now are going to put so much more weight onto and going to be looking at how companies treat their employees. And it is going to be a differentiator as to whether or not those companies get money or not. And certainly in the private equity space, companies need to think very carefully now about how they deal with their employees, because it's not just about being a good company and looking after your employees, but it's about supply chain security and risk over the long term. Companies that have done the right, that were doing the right thing anyway, that were looking after their employees, for example, a classic example is work-life balance. Okay, allowing your employees historically to spend some time working from home, generally a really nice positive thing. It's a good vibe for employees. Those companies have been okay because the employees are used to working at home. They've got their setups at home, and they've been able to, all within reason, carry on with a sense of normality. Those that have always forced a work environment, a lot of these guys have really struggled because they haven't thought about the real wants and demands of the employees. So I think that's going to be a key focus going forward.
Our hour is almost over, so I'm going to go to the last couple of questions. I hope you don't mind if we go a little bit over time, given the huge amount of questions that we're getting in the Q&A. Now, again, on the point that you were just discussing, how how companies treat their employees and some of these social factors, I don't envy you on the data side, because a lot of these things are so hard to measure, right? These are qualitative factors, right? And a lot of these qualitative factors, to assign a quantitative metric to them is not easy. I know that you have done quite a lot of work, and that you are continuing to do work to be able to do those things objectively. And I'm sure there are plenty of people on this call who would like to learn more at some stage on how you do that. But shifting to another aspect, and this is expanding on a question asked by Maria C. Powell regarding governments, policy, tax incentives. So one of the reasons that I like ESG and impact investment, and one of the reasons that I believe that these investment classes have outperformed but will continue to outperform. People think, oh, well, there's so much money going into the space, and that's driving up prices and valuations. Well, I don't think that that's the sole explanation. I mean, for sure, obviously governance, companies with good governance are going to be doing better for shareholders. But what you're actually also doing, and correct me if I'm wrong, but is you're front running effectively policy. You're front running a lot of policy changes that are supported by people and will eventually be affected into some kind of government policy that will have some kind of economic impact. And the companies that have been effective in implementing those policies ahead of time and sustaining to them and sticking to them, not only do they get the benefits of having better employees and people want to work there and so on and so forth, and people want to be their customers, but they also are ahead of the curve on policy. And a lot of these things can be reflected into tax. So Maria's question was actually how tax incentives, what can governments be doing more in terms of tax, because that's part of the role of government and tax systems in order to try to create that balance and divert capital so that it focuses on the social good. Is there what kind of and how does that factor into investments and creating infrastructure that actually has impact on communities, on the people, on the voter, on the taxpayer? Bert, if you may start on this one.
Wow, I mean, that's a very deep question, well beyond my pay grade. But I would say, in talking with governments, I do see governments more likely to give concessions and more likely to negotiate, whether PPAs on green energy or whether they are speedier rulings. We all businessmen, in a sense, will have to take into account the regulatory framework, and stability is really key for us. I think what you stated, Zach, is absolutely right in terms of anticipating where governments are going. If we can demonstrate that treating our employees, providing some training, a number of issues, not only in health. Of course, there are some tax benefits already for savings plans, et cetera, depending upon which government and country we're talking about. But I think the most of the governments that we deal with in our 35 countries, they're really struggling on the fiscal side. So for them to make much more room on taxes in the short run, I don't see so much. I see much more their willingness to help us speed up investment decisions, potentially also to find capital or to encourage local capital. That may be negative. There may be some countries like Colombia, which allowed their pension funds to go all over, may in fact try to screw back and require 20% of pension fund assets staying in Colombia. I don't know. But I do believe that the governments are looking to work with people that they can trust, that would make an impact on their communities, and they will use what weapons they have, both negative and positive, to bring that. For our perspective, I think it's a clarity and a speed at which the governments can deal with us because they trust us, and instead of worry about being criticized. On the tax side, I'm just not so much on that. Maybe Andrew, you've got more, but I think that gets very much more complicated given the place where governments are today.
Look, I like you, Bert. I can't really add anything any more on the tax side of things, I'm afraid. But if Maria, if it's something that you want to find out more about, we can certainly put you in touch between us with experts who can answer in a more fulsome way. So sorry, we can't probably answer as fully as you want.
It's going to depend very much on the government, which country and in any case.
Yeah. Absolutely. Yeah, absolutely. I'm sorry. It's a big question and challenging one, but let's for our last question, let's talk about deals. Let's talk about deals on the ground. And one of the questions is asking, following up on one of the things that you mentioned, Bert, is the struggle to find big enough deals in ESG for those who want to deploy capital into the space, the challenge on that. And then I'd also like to understand, how has the deal landscape changed, if at all? Because you're looking at deals all the time. How has it changed, if at all, in the post-COVID era? If you could touch upon both of those points as our final question, both Andrew and Bert, maybe on this one, if Andrew could potentially start.
Yeah, look, I think it's capacity is without a doubt an issue, and I think what you've got to break down, what is ESG investing. Go back Not so long ago, an ESG index was one which wasn't investing in munitions, tobacco, and so on. I think we can all agree now that we've moved on significantly. So not only have you just got negative and positive screening on equity products, but you're going much deeper into very positive, sustainably focused private equity models that are actually embedding meaningful change into private companies. So you've got a massive range of ESG products at the moment. Certainly on the private equity side, without a doubt, we are seeing more and more capacity develop. Is it coming on board quick enough for the big institutional investors? That's a good question, and I get the sense that it's probably not coming on quick enough, but it's certainly happening. But the other thing I want to say is this: when we're talking about ESG, you don't have to be labeled as an ESG investment, in my view, to have a positive ESG portfolio. ESG should be applied to all companies. And look, if I'm sitting here if Bert and I are here in 5 years' time talking about this, I like to think that every investment integrates ESG matrix into its strategy. Yes, you will still have the very, very specific impact from investments, but every type of investment should be incorporating ESG strategies and matrix into its investment decisions. No, there's not enough yet, certainly when we get down to the very specific private equity style, but as Bert mentioned, you've got access to vast notional amounts of social environmental bonds now, which to an extent are satisfying the market for the moment.
Yeah. I think that is good answer, certainly cross-cutting. I would say in terms of big deals, part of the issue is really large companies with assets are quasi-regulated already. We look at the banks, you look at telecom, you look at power, and many of those companies are under an obligation to provide a certain product that was defined and regulated before ESG and impact became a real theme. Hard to move those guys out. It's hard to go to a bank and say, you're going to be 100% impact. You could certainly provide products. You could certainly provide inclusiveness too. But I think one of the reasons why there's so many small deals which are interesting is that they're using new technology, targeting certain sectors, whether they're SDG related or whether they're specifically measurable according to some of the metrics which investors should care about. What we then see is, well, multi-country is where you can get a lot of money put out, but most funds are organized to have 4 smart guys in a room, and they're going to be doing deals within 4 hours of their capital city. So you really need a kind of a new form. One of the things that we do on tech deployment globally is we're in 30 countries, and the reason is that there may be some really good tech, but in Kosovo, there's probably only $1 million in revenues from that tech. If you're not in 30 countries, you're really not going to get scale on that. But I do see post COVID tech enabled, whether health, education, financial. I mean, a lot of our companies also in Morocco at this stage, there's people are getting used to doing mortgage applications or consumer debt applications on the internet, which is then interfacing with banks, both Islamic banks as well as the commercial bank. And Islamic banks, so there's less people there, so they're more ready to adopt this kind of digitization in Morocco. So I think that the answer here is that the society has to move, other than debt for clean buildings, clean energy, which I think is easy, moving towards hospitals. But even there in hospitals post-COVID, we're seeing more clinics. We're seeing that people don't want to be in a general hospital. We want to see specialization. And so inevitably, we're finding a lot of deals at the sort of $5 to $15 million level, much less at 50 million and up. So, and that's frustrating some of the large asset allocators, because they want to be in 500 million to $1 billion funds, and it's just not that easy. So I think that what Andrew is talking about, I think, is a terrific start for all companies. They ought to be able to take into account ESG issues. If you then move on to impact, I think you'll probably start talking about some smaller deals first. And then the question is, can we consolidate, roll out in enough countries within the normal allotted time, the 5-6 year hold period that you have. So I think we may be moving to permanent capital vehicles that are able to in effect spread through more countries, particularly if there's a current income sort of component to it. But it's a great question. I hope you know, in the very short period of time we can talk about some of the factors there. The very large companies, Tokar, are to some extent their businesses and how they deliver their businesses already settled. That'll probably change after COVID. Whether enough on the impact side, we'll see.
Well, I think that that's one of the important roles that you know, funds and fund managers play, is helping these large institutional allocators, you know, deploy large amounts of capital. But you know, fund managers can roll up their sleeves and do smaller deals. And you know, that's some of the work that you've been doing, and some of the work that many of the clients of Apex do that we see every day. So you know, while there's been, in many other asset classes and many other themes, there's been this kind of move away from funds, more to direct deals, more to investing directly, and that's been a shift, I think, for this particular space. You know, we need funds, we need fund managers, we need, you know, it's a different, also because the data is changing, it requires an expertise, right? It's not, a lot of this stuff is not, you know, so clear cut. You need someone who has the ability to differentiate between someone who's gotten, you know, some tick box, self-reported report card that says that they're ESG friendly or sustainable, and someone who actually really is. And that's where asset managers, fund managers can actually really add value, is in aggregating smaller deals that are too difficult, and doing that in enhanced analysis that is required to really understand where when we're getting past the marketing and having a real impact, and really driving the ESG mandate forward. So we've already gone 7 minutes over time. That's all the time that we have today. I cannot thank you both enough. This was a really excellent session. I'm so sorry to everybody in the audience who I didn't get to answer the questions of, but we're going to share the questions with both Bert and Andrew, and hopefully be able to follow up with your questions at a later stage. Next week, we will be having another AIM Summit webinar on GCC markets, investment themes, and market dynamics in the time of COVID. This is going to be sponsored by SICO, led by the Chief Executive Officer of SICO and the Head of Research. We have a lot of people in this audience who have exposure to the GCC, to the Gulf region, to MENA, and would love to understand about the investment themes and market dynamics in the time of COVID in this region, which is particularly exposed to the disruptions in energy and has a lot of unique circumstances. So please join us for that session next week. Andrew, Bert, we covered so much ground. We talked about you know, taking a more sophisticated approach to sustainable investing, understanding the data, the importance of data, things that, you know, may be harder and easier to quantify. We understood the fact that COVID-19 has actually accelerated ESG investment, the importance for allocators, the importance for investors. It's also changed the dynamics of deals. It's changed the dynamics of how we deploy capital, but all driving towards a more resilient, more sustainable future where we're not constantly having to be reactive, but can be proactive for both the social and the environmental issues that are arising, are continuing to arise, and are very much on the horizon. Thank you again, gentlemen, so much for joining us. Thank you for everyone from the audience who asked questions, who engaged, who attended our webinar, and we really look forward to hosting you all again. Thank you so much.